Hey there, everyone. Today on the final bar, risk-on move for stocks after the CPI this morning. S&P 500, the NASDAQ 100, both up about 2% plus for the day. We're going to dig a little bit into market breadth indicators. Are they confirming this rally phase really exploding to the upside today? Finally, we're joined by Pete Carmasino of Chaikin Analytics. How is he thinking about the interest rate environment now in the new world of the changing Fed expectations? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Technical Toolkit is really designed to empower investors to better appreciate the message of the markets themselves by analyzing price action and all those derivatives like different technical indicators like moving averages and even more different statistical tools. Also measures of breadth and sentiment, other ways to qualify the movements that we're seeing in the major indexes. Asset allocation, what we call intermarket analysis, looking at different asset classes and how they're rotated. I would argue if you want to make sense of things, if you want to improve your situational awareness as an investor, it has to start with the charts because that's where you can really understand the movement of the markets, the relative performance, the relative value of different asset classes, and most easily identify shifts in sentiment. Now, when we talk about this market, we've talked about the short-term bullish configuration we've experienced here over the last week to 2 weeks, coming off of the swing lower in October, this rally going into now mid-November. This week, all about the CPI number this morning. Would it show that, or imply, I guess, that the actions taken by the Fed to date have been enough to bring inflation into more reasonable levels or more to their targeted levels? Today, you get the softer inflation reading, market taking that as a big bullish sign for two reasons. Number one, it makes the likelihood of an additional rate hike at the December meeting almost minimal. If it wasn't already, it's certainly pretty much a zero at this point. But it also brings forward that timeline about future rate lowering, right? When you sort of have rates where they need to be, as assumed by the Fed, at some point you sort of get through this period and rates can start to come down a little bit and give the market room to grow, particularly growth stocks, which arguably have not had any trouble in 2023, but it certainly makes it a more ideal environment for them. It's bringing that timeline forward a little bit. So now you're getting comments, not too long ago, we're talking about the Fed maybe lowering rates way down the road in 2024. Now that's coming earlier in the year. We'll see as the markets sort of digest further what we got today. We'll see what happens through the remainder of this week as we get some retailers reporting earnings, we get some other economic data. But at the end of this week, I think it'll be an interesting place to take a step back, maybe lick our wounds if you're bearish, and reflect on what evidence we have now. We're going to be talking about some upside objectives now that we've broken into some new swing highs. So let's get to the market recap, see how the charts have evolved. Before we get to the charts, I do want to start with a poll question. We've started to ask a little more regularly this question. What's your outlook for U.S. stocks over the next 6 months? Bullish, bearish, neutral? Clean and simple, where are you at? Now, it's interesting. It would be funny if we asked this question right at this moment after today's sort of bullish short-term mode. And that's one of the understood issues with any sort of breadth data or any sort of sentiment data is it really is time stamped, right? It depends on when you're asking that question and what's the most recent data that people are basing it off of. Pretty spread between these three answers, but bullish by far the most common answer. Almost half of you said bullish. Only 28% of you clicking the bearish button. At least about a quarter of you in the neutral category. I can't disagree with that. Now, 6 months is an important time frame because when you're looking 6 months out, it's really not about the short term. It's not about the flickering ticks, the short-term upswings and downswings. It's more about the bigger picture trends. I would argue it's more about seasonality. Now we're getting into more of an election year and what the seasonal trends tend to be in a year like 2024. So market moving higher over the next 6 months does give room for there to be some drawdowns, right? Certainly in the beginning of next year, maybe that's when the market sort of pulls back a little bit. But overall, I'd probably agree. I'd probably say bullish for the next 6 months. And I would say with the big caveat that one of the great benefits of technical analysis is that you don't have to put a trade on with a 6-month horizon, like a CD, and then just be subject to whatever market forces evolve over that time. One of the great benefits of technical analysis, and hopefully what you can use the stock charts platform for, is to better manage risk, to recognize as the market and as the picture is changing over the next 6 months. And maybe there are clear signals that there's what's called a change of character. With that in mind, let's continue with our market recap and look at some of these charts because they turned up in a pretty big way here so far this week with a positive reaction to the CPI number this morning. The S&P 500 drew down a little bit in the last half hour or so, but the bullish movement really established early on in the day. S&P closing just below 4,500. That's up 1.9% from yesterday's close. The Nasdaq the Nasdaq Composite up 2.4%, just below 14,100. Mid caps and small caps up, and look at this: the S&P 600 small cap index up 5.5%. I don't have the data in front of me about biggest up days in 2023, but I would have to assume this is one of the top days with the S&P 600 up 5.5%. To put this into context, I mean, the story of 2023 has been the Nasdaq 100 up, we'll call it 45% year to date, would be my guess, based on what we've done. The equal-weighted S&P essentially flat for the year, and small caps, Russell 2000, has been negative for the year. A day like today, I mean, this is a huge mean reversion move for areas of the market that have been struggling quite a bit. Mid caps are up 3.9%. So one of the big, I think, caveats of the strength of the market in 2023 has been the narrow leadership, right? A small number of huge stocks having incredible years, the average stock having a much more measured year in 2023 performance-wise. Again, I still think a lot to prove. This is one day's reaction, but starting to see some pops in areas of the market that have been lagging in a pretty big way. All of this bullish movement that you see in stocks today pushing the VIX down toward 14, not quite getting to a 13 handle, but really, really close. Yesterday, we kind of pushed back above 1450 to like 1470 or so. Today, we're back down testing 14. So again, by any definition of volatility, high vol versus low vol, this is very much in the low volatility arena. This tells you volatility is low, spreads are coming in, overall conditions are risk on, and you're seeing that with risk assets really generally pushing to the upside. Now, of course, bond markets have been rallying as well on this news. The TLT up over 2%, about 2.3%. So, you know, big tech and bond prices having a nice big up day, both over 2%. But that, of course, is bringing yields down. So the 10-year yield, which was up to 5% not too long ago, actually down below 4.5%. As of this broadcast, finishing the day around 4.4%. The long bond yield around 4.6%. 5-year point similar to the 10-year point. So bond prices rallying now on this news. Interest rates coming down. Higher rates have been, you know, certainly one of the stories here, I think, of the last 12 months for sure, in terms of big market conditions to reflect on and think about. You're seeing a big deal of mean reversion here recently with rates coming off. Is this the beginning of a broader advance in bonds? We have a great guest today, by the way, Pete Carmasino of Chaikin Analysts. We'll talk a little bit about the interest rate environment, some of the other rates to track, by the way, that you may not be looking at on the Stock Charts platform, but hopefully you will after our conversation with Pete Carmasino. Let's continue on here. Commodities mixed, to be honest with you. The energy part of commodities, like oil and natural gas, actually in the red. The precious metals moving higher, so silver actually pushing higher. This is one of those days where I feel like there's a shock to the system in the fact that inflation data was much lower than expected. Kind of everything's moving. This is one of those where it's sort of like the big movement. This is the big meal. This is your Thanksgiving dinner, to use a timely sort of reference point. I think the next couple days are after the dinner when you're sitting there watching football, trying to recover from your meal. That's when we see where things actually, where they sort of line up. Today we had the big reaction. Interesting to see silver popping higher at a time when safe havens like gold, you'd probably expect to move lower. They're actually pushing higher today. Finishing up with cryptocurrencies all rolling over. So all 10 of the top cryptos that we track on our Stock Charts platform in the red, and that goes from Bitcoin and Ethereum down about 3 to 4%, down to some others down a little bit more. Ether price is now back below 2,000. Bitcoin pulling back from 37 and change to around 35,250, we'll call it, going into today's broadcast. Finally, looking at sectors, I mean, it wasn't the juicy stuff at the top of the list, just like, you know, some of the more defensive areas, or I guess, you know, areas of the market like financials. We have some of the groups there up pretty significantly. Real estate is your top performing sector today. The XLRE up 5.4% today. Utilities, number 2, up 4%. Consumer discretionary up 3.4%. On the downside, all 11 sectors up, but a couple of these are only up about 1% or less. Healthcare, energy, and consumer staples are your 3 worst performing sectors. But again, all 11 to the upside. And again, real estate and utilities are interesting to see at the top of the list today. These are some bond proxies, to be honest with you. These are some income-oriented members of the equity space, and also sectors that have been underperforming for quite some time. So kind of everything getting a bid coming off of this weaker period for some non-growthy sectors, and you're seeing some moves to the upside. Let's go to a daily chart of the S&P 500. Just kind of check in on how things are playing out. So this is what a day like today does to your beautifully articulated chart of the S&P with all these pretty lines and levels, and everything goes out the door like that, which is one of the great joys of being a technical analyst, I will assure you. But here's what happened, right? We have to acknowledge this is a nice gap higher. We talked about the 4,400 level. My most recent YouTube video on my channel called Market Misbehavior was focused on that S&P 4,400 level, why it was important, what we would need to see. We saw a close above that 4,400 level. That was at the end of last week. The question coming into this week, do you see follow through? Yesterday was sort of the sit on your hands, let's wait to see what the CPI data is. Today you get that follow through, a gap higher. Now we have a new gap on the S&P 500 chart to pay attention to. But I would argue this now starts to put these other levels into play. So again, one of the reasons why this show is called the final bar, because I would always teach people, start with the current price, the final bar, and then look to the left and think about where we're at relative to where we've been. And if you look, you have some overhead resistance kind of right around current levels, 4,500. That was the most recent swing high there in September. I think the real level now is 4,600. That means a retest of the July peak. Given the gap higher, given the strength, I think that level's now in play. I think that's a reasonable upside objective. Do we get above there and start talking about a retest of the all-time high around 4,800? Is 5,000 in the cards now going through this seasonally strongest part of the year? I don't know about that. And as we've moved higher so quickly, my eyes are immediately drawn down to the RSI. And again, we're not overbought yet. We are clearly now in the bullish range where the RSI is above 60. It's showing strength in the market, and that's certainly what I'm seeing from risk assets. The question now is, when we become overbought, that often becomes an indication that we're at the latter stages of this rally. And it could still be a bullish move, but you usually get at least a bit of a downside move, or you start looking for divergences. And that's what we saw at the end of July, which is the market moving higher mid-July to late July, this bearish divergence. So now that the RSI kind of gets up toward that overbought region, I immediately start thinking of some of those previous times when this nice move higher starts to bump into resistance, where people start to take profits, and you get at least a short-term move down. And that's where we start thinking about a higher low. And that's where we'll start looking about some of these levels again, maybe 4,400, maybe down to 4,300, which is the level we've talked about as well, the 200-day moving average. Those are all places where a potential pullback could find support. So for now, certainly a strong move, a resumption of this uptrend. If you've been fighting it, which I think in a lot of ways I feel like I have, nice upside follow through. The equal weighted S&P, we've talked about one of the things we've not seen yet, improvement in breadth, improvement in things like the equal weighted S&P 500, the equal weighted NASDAQ, which are the two series we're looking at here. The regular cap weighted SPY and QQQ already above their October highs. We've highlighted that in this push above 4,400 for the S&P. The equal weighted versions had not until today, but now you're actually seeing both of those make a new swing high. And so that's showing you that it's not just the biggest names. A day like today is really a broader advance. Advancers clearly outnumbering decliners in a pretty significant way, I would hazard a guess to say. So overall, sort of an improvement on some of the issues that we've been highlighting on this market. Quick glance here, and again, there are a number of different ways you can highlight this. We're looking at the percent of advancers as a percentage of the total listings on the New York Stock Exchange, just over 90%. So a 90% update based on that basic description. That usually happens in a bullish phase, right? That's not something you get during bear markets. This is something that's more of a constructive development for the markets as a whole. You know, I mentioned Bitcoin, and just to go quickly to the chart of Bitcoin and look at a couple individual names before we take a quick break and bring on today's guest. But when you're looking at the chart of Bitcoin, I just want to highlight, as other risk assets have pushed higher today, cryptocurrency is actually moving contrary to that. It's interesting, Bitcoin and stocks for at times have been very similar, right? They sort of move together, and Bitcoin all of a sudden feels like a risk asset like others. Today, you're sort of getting a disconnection from there. Cryptocurrency is actually broadly declining today, while other risk assets are actually pushing to the upside. So a mean reversion from what we've seen previously. This drop in Bitcoin, and again, still just above 35,000. So not an end of the world move just yet, but a pretty big down move after this strength that we've seen for quite some time. This is coming out of that overbought region. This all of a sudden is looking very similar to what we had in January, which is an exponential rise. I mean, just look at the slope of this advance, very similar to the slope of the advance you saw in October. We then had this additional move higher as the chart becomes overbought. You had that same thing from mid-October now until mid-November. Then we came out of that overbought region. It wasn't the end of the world, but it did mean about a choppy 6 to 8 week period before we were finally able to make a new swing high. Maybe that's what we're setting up for between now and year end. We're going to have a conversation. I think that's later this week, very soon, with a couple experts focused a little bit on cryptocurrencies. Adrian Zadunchik, who's been on the show before talking about cryptocurrencies, and also Jeff Hurst, who's done some great work with Adrian on seasonal shifts and seasonal trends in Bitcoin. November, December actually tend to be quite strong. Fourth quarter actually tends to be pretty good. So we'll see what happens between now and that conversation, get their take on things. Just to wrap up here, I just want to highlight a couple individual names, and then we'll move on from our market recap. We've highlighted this chart for quite some time. I just want to revisit ROST stores. Now, this is leading up to earnings, which are coming up Thursday. I was just looking at the, I don't know if you've noticed, by the way, we're always making little improvements on the stock charts platform. Some very big improvements coming very, very soon, including a new format for this page, the workbench. And if you want to see a preview, just click on that blue note right below your chart. If you're using our Sharp Charts platform, you'll get a quick preview of what that's going to look like. Pretty close to the finished version, but a much more updated UI. Some really great ways to manipulate the charts and change the data and share and send them as well, which I'm really excited about. But one of the minor changes we made, we started to add earnings dates up into the quote line here above the chart. So make sure you have that turned on. You can see quickly here they're reporting on Thursday. This is kind of a retailer week with ROST stores, with the Gap, with TJ Maxx and others reporting. But what I wanted to highlight here, a cup and handle pattern. And I would say with today's move, you're kind of validating that breakout. A cup and handle pattern is where you have a move higher, this sort of shallow, rounded bottoming pattern, retesting of the resistance, and then this briefer sort of pullback. There's your handle of the cup, and there's the big, body, the bulk of it. And then we break above that neckline or the rim of the cup. That really suggests a strong move from here. So leading into earnings, chart like ROST store is actually in a very strong technical position, I would argue. So it'll be interesting to see what that means relative to the earnings release coming up. Some names that have been beaten down, actually having a nice day here. We'll finish with two stocks, or one stock, I think, that does provide that, and then a different one in a bit of a different phase. But if you're looking at the chart of First Solar, renewable energy, this is FSLR. Enphase is another name in here. Another one that was up, 16% coming off of the lows out of that oversold region. First Solar drew my attention because another sort of classic bullish divergence, right? The lower lows, early October to late October, higher lows in momentum. We're oversold in early October. We are not in late October. So lower prices, higher momentum suggests an exhaustion point or a likely exhaustion point to that downtrend. Suggests we might be rotating higher. Now, not really seeing that upside follow through today. We're pushing higher, up 11.4%. We're still below the 50-day moving average. I still think a little bit to prove. I'd like to see a move above 160, which I think would complete that, upside rotation. But certainly giving the signs of a potential move to the upside, we're starting to see some follow through there. Then McKesson is another one. Just like we're seeing bullish divergences on a name like that, McKesson has been a pharmaceutical name actually doing quite well. We're above two upward sloping moving averages, which most stocks would not be able to describe themselves that way. But just in the last week, I think validating a bearish momentum divergence, higher prices, lower momentum. So divergences are often a leading indicator of a rotation to come. And I think you're seeing more and more of those, or certainly I'm seeing them more and more of them as I review some of the charts in the U.S. That's it for our market recap. I want to bring on today's guest, Pete Carmasino, here in a minute. Before we do so, just a couple quick announcements. First off, we welcome your questions. The mailbag has been so much fun recently. All of this uncertainty, all this movement in the markets creates a lot of questions. We're here to help point you in the right direction as you are trying to use the Stock Charts platform to better understand these markets and better make make better decisions for your portfolio. You can email us your questions at thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV. And on our YouTube channel, of course, you can use the live chat feature, which is turned on our live shows. On any of our shows, just put a comment below the show that you're watching. We'd love to hear from you. We hope to answer one of your questions in our next mailbag show, I think coming up later this week. One other thing I want to point you out to, this is our Stock Charts TV channel. We have so much great market commentary and insights from experts like Pete Carmasino, Grayson Rose, and many others. We have another channel I would love for you to explore as well, especially if there are people you know that are just getting started. There's some really good tools and tips and tricks on how to be a better investor, how to make sense of these markets. It's called Stock Charts, and the way you get to it is on our YouTube channel. Go over to where it says channels, and you will see the growing lineup of Stock Charts YouTube channels. This one is simply called Stock Charts. Make sure you subscribe to that and get the notifications. You'll see some really cool content, including some fantastic documentaries about Wall Street history. Some of these early financial panics, one of our producers, Abara Saunders, done a really good job explaining what happened and how it's still relevant in 2023. Also, some great insights on how to use stock charts and how to be a better, more well-rounded investor. So make sure you check out that other YouTube channel as well. I want to bring on today's guest, Pete Carmasino. Pete's the Chief Market Strategist at Chaikin Analytics, coming to us live from the Tampa-St. Pete area in Florida. So Pete, great to see you. I'm sure you're enjoying a little better weather than we are here in the Pacific Northwest, but hopefully you can shed some light on the market conditions as well. How are you, Pete?
I'm great. It's good to be here. And I think you said you were coming from sunny Redmond, Washington, didn't you at the beginning? All right. So I'm in cloudy Tampa. I mean, we're in the bizarro world here.
It's mean reversion in weather. It's mean reversion in markets. Everything's going out the window. All of
everything's doing, what's unexpected, right? And so I think it's perfect for today.
I love it.
Excellent. It's great to be here. How you been? Everything good?
I'm good. No, it's good to see you. And thanks for coming on. Obviously, the CPI number today, really surprising markets to the upside. Big move in risk assets. Can we talk a little bit? Start us off with interest rates. I mean, rates sort of steadily moving higher has been part of the story in 2022, 2023. What do you see as you're looking? How do you make sense of what we learned today?
So I got my start in the bond business, right? And that's really where I started in our business, and it was on the bond side of things. And I'm glad I did, because in the beginning I felt like I missed something, right? I was like, I was paying attention to interest rates and bonds and things of that nature. And then as I grew, through my career, obviously stocks came into play, but I never not watch bonds. I always do. And it's really the three-legged stool, right? It's the bond prices, which will push rates around. I can debate many people on this. It's bonds that move rates. Let's be serious here. That's the rates don't move the bond prices. It's the other way around. And so when you see these trends, you can start to extrapolate targets. And that's what I've been kind of paying attention to. So it's bonds, it's rates, and it's the dollar, right? And all of that is, is pushing and pulling on this market, left and right. And the TLT is something that I was calling out back in December of 21, when it was, 145, 150-ish. It had already started a trend, but the Fed was basically at a neon sign saying, look, we are going to raise rates. And as inflation picked up, it was obvious that was going to happen. Now, not a lot of people took advantage of it. And if you were able to, you can see the trend. Now, I built my first target was 97. It hit there and then bounced. And last time we were on the show together was back at the end of May, and TLT was trading around 102, 103 or so. And it's since pulled back about 19 to 20% since that price, but it came to the top of my range. Now, I had 75 to 80 as my target, but the top of that range was built all the way back from the top. I think that's 08, 09, all the way over to the left there. That was really where I thought it could wind up, but I really thought that the 10-year would be over 5, but it got to 5 and turned around. But there was another famous guy who was talking about taking shorts off the bonds just a few days ago. He got a little bit more headlines than I did on the trade.
And so as the TLT is now testing this support, this range we've been talking about, what does that mean for interest rates in this rally? This rise in rates? Are we at the end of that period then?
I think perception becomes reality, and that's what we're seeing here today. We saw CPI come in. It was heavy in some areas, but flat over on the core. Core came in a little bit. There was one piece that somebody said something about, your healthcare costs going down 34%. I'm in my pre-enrollment period right now. My healthcare costs are not going up, or not going down. They're going up. So I'm not sure who's getting those. But this I always like to look at these bond ETFs or bond proxies, like you talked about, real estate or utilities, whatever, that
Mm,
just tells me where rates are going. So
yeah.
on these bounces, it's not like TLT went straight down. We can see the chart. It doesn't go straight up either. And so, these are these fits and starts, and even the trend on the lower panel there of the 10-year, it's the same kind of choppy situation, but it is, dominantly on the upside, right? You can't, it's undeniably in an uptrend. I
Yeah.
still think we could see something above 5. I'm not sure what it's going to take to get there. I'm less confident now than I was yesterday, but I think TLT is kind of, run its course, and it got right back to where it looked like it should have based off the chart. And I think it was a technical move.
Yeah, and this is a weekly chart. I should have pointed out the daily chart. You're
Yeah.
certainly seeing that short-term strength off of that
Yep.
support level. Talk to us about the
Absolutely.
S&P. Of course, big gap higher today, which I know a lot of people are focusing on. How does this fit into the trend overall that we've been observing here in
Yep.
2023?
Yeah, I mean, this is where I think we're all kind of like, wow, what's happening? I got my RSI on here. I think it's the same level as you're using as
Yep.
14. We're getting to that upper end of the range, but we're in the middle of that up channel that I built. And I had 3 gaps built on this chart, and I was kind of paying attention to them to be, more of a target area. Now, the recent one that we filled right around that 4,400 or so was definitely resistance, right? It
Yeah.
worked very well, and then it became a target on the upside. Now, for all I knew this looked like it was going to be a spot was going to be really hard to get through. Well, that didn't happen today, as you said. The joys of being a market strategist and being turned wrong on a dime in one day, but that's okay. Now we've got a new trend developing, and it's back inside the channel. The 200 really didn't do much, right? It seemed like it was sort of a non-event. It really came back to that 4175 4200 area that was more important. And so that's what's great about technical analysis. Yeah, you can throw a moving average on there, but you really got to identify spots and areas on the chart that mean something. Now, you mentioned it earlier. Can we get to the top of that channel? That would be monumental. That line across the top is the high. And I think, if we can get there, it's inside the channel. It's not out of the realm. But I still think that, we're going to see, I think we're seeing the FOMO trade. I think people got ahead of themselves thinking the Fed is paused or maybe even done
Yeah.
and potentially cutting sooner than most people talked about.
Yeah. I
Which you
feel,
got to
and
be,
again,
it has to be bullish for stocks, right? I mean, at some point.
it's certainly seeing that. I think we share probably a skepticism in terms of the upside move, because I feel like a shock like this, and maybe I've just seen too many bear rotations, but I just feel like we're one bad headline now from a gap lower. But let's
Yep.
celebrate today. I mean, big victory for risk assets.
That's a great point. And I'll talk about something. I call this kind of like a happy hour rally. I wrote a piece a few days ago. It's like, they sell the cheap stuff at happy hour for a reason, right? I mean, it kind of draws you in. It creates a nice crowd. It's a lot of fun.
Yeah.
We're in this FOMO, area where we hope happy hour prices don't go away, but they went away pretty quickly. I mean, the prices are getting more expensive. And look at some of these solar stocks and some of the names you were pointing out today. These are
Yeah.
massive, massive moves.
I read that note on the happy hour rally. It was a great analogy to use, Pete. Let's look at some of the other indications, broader indications we're looking at. We're looking at unemployment on the top. This is a weekly chart. We have the prime rate and then the S&P. What is this chart telling you about the historical conditions here?
Yeah, I mean, I feel like I'm trying to find some things that are kind of absolute, right? And that's really hard to find in any kind of market. But there is really no time since 1990, I think 91, when this chart goes back to. And I'm using the prime. You can use the Fed funds rate, but I thought I'd use the prime because no one really talks about it. It's obviously the prime rate that the best credit worthy folks get when they're taking out loans, whatever the case may be. But every time unemployment starts to shade a little bit higher, move a little bit higher, and get to the point where it starts to tick, maybe to a point where the Fed says it may be time to act, not just because of unemployment, but potentially for a lot of things that we're seeing out there, right? So CPI or inflation might be pulling in. And if all of the ducks kind of get in the row, unemployment sometimes starts to tick up after the fact. It's the lagging indicator. Now, typically, you're going to see the Fed come in and have to cut. That we talked about that today. I think the cut they were talking about maybe June, and now it's been pulled forward to May. And I don't think that's wrong, but it's when you're cutting rates, we have to remember that's not typically a good reason, right? It's typically something that the high rate environment of work, the slowdown occurred, and now obviously you're seeing companies cut prices. So if the top line has to go away, the bottom line gets squeezed and they have to lower expenses. Unfortunately, that means sometimes unemployment ticks higher. But if
Mm.
to get that rate cut, I think that's going to have to be what happens. And we're up. I was looking at July was 3.5% unemployment. Then we went to 3.8. Then we went to 3.9. It's slowly sort of migrating a little bit higher each month.
Yeah, really interesting chart. Thanks for bringing some of the long-term perspective in there. Really interesting relationship there. Just to
Yeah.
finish off, Pete, let's talk about some of the groups within financial, starting with regional banks, starting to rotate a little bit. And this is a group that's not done particularly well. What do you see here?
Yep, you got the on the top panel is the full ETF to KRE, and
Yep.
then it's the ratio to the SPY down below. And typically you want to see strength, right? And there's the famous bond manager came out just a few days ago, Bill Gross. He's talking about banks. Now he was talking about them as a bond proxy or a surrogate bond play in a way because they've their book values are so low, and obviously they've got a ton of money, like most banks, in bonds or fixed income securities because they have to from a regulatory perspective. But their business model is a little, I would say, skewed back to that prime rate. It's hard to find borrowers at that level. And remember this, I worked in the banking environment, for on the investment side of like Wells and Lehman and things of that nature. And it takes two to tango, right? The banks have to have the willingness and the ability to lend, but so the borrower has the willingness and the ability to borrow as well. And so when those two kind of bifurcate, things slow down. But this banking environment, I mean, this is up 7% today. This
Yeah.
to me tells me I'm not sure it's a good signal. It's a great trade. Thank God, somebody took advantage of it, and maybe Bill Gross did. My point is that if it moved just because we think the Fed's pausing or cutting rates, that doesn't really bode well for me for the business model. So I'm a little leery of it,
Mm.
but the trend doesn't seem to be ready yet. It's getting close, but a 7% move is undeniable. I mean, it looked like a massive, big bounce today.
Yeah, nice bounce. Still below the 200-day, kind of testing it now from below there.
Yeah.
Insurance, kind of in a different phase. Insurance, I mean, when you look at the financial sector, insurance certainly at the top of the list of
Yeah.
performance-wise. What do you think going forward here after a group that's done quite well on a relative basis?
Yeah, I've done a deeper dive in this category, and not all insurers are painted, are the exact same. They get painted with the same brush in sort of an industry or sector ETF. But some of these like property and casualty insurers,
Mm.
they're getting the ability to pull in premiums, and premiums have increased along with inflation. What they were able to do was to pull back their maturities. In other words, instead of being on the long side, they're now in the 2 to 4 year range. So they're benefiting from this move. I think their business model is still intact. It looks great, and they're set up for a better move in their own investment portfolio. So I like this over the regional banks only because from a property and casualty insurer versus a life insurer, the P&C companies are insuring something that might happen. So in sometimes, they get to keep those premiums if someone cancels or whatever the case may be. If there's no payout and they're good at underwriting the risk, their business models stay intact. Now, a few of them are looking great. Life insurers are insuring something that eventually is going to happen. So they have a different makeup. But I think the insurance group in general, from our perspective at Chaikin Analytics, the power gauge turned bullish and things started to look a little bit better. So I do like the fact that the KIE is kind of participating, not as much as I thought it would today, but
Yeah.
to me, the trend looks a little bit more stable.
Pete, this was awesome. I really appreciate you coming on today, putting some perspective. I know the market moved very quickly. A lot of people searching for answers. I'm sure many of them got some of those answers here today. Be well, stay safe. I will hope for a sunnier weather for you, and I'm sure that'll happen here very, very soon. But I'll talk to you again soon, Pete. All right.
You got it. Thanks, Dave. Take care.
That's Pete Carmasino. Pete's the chief market strategist at Chaikin Analytics down in the Tampa St. Pete area. Some really good thoughts there, and I love on a day like today. It's a real what a pleasure to talk to someone like Pete about thinking about what that means for rates, really the trend. And if you notice a consistent theme with a lot of my guests, and we don't just willy nilly bring on guests. Like we curate the people that we think deserve your attention and whose expertise I think are worthy of your attention. Think about how many of my guests come on with these long-term charts. They're not showing me hourly charts of the 10-year and thinking about what that might mean. We're looking at weekly charts. We're looking at longer-term cycles and a historical perspective about what has been happening during previous economic cycles. Great lesson there about the power of using a platform like Stock Charts to really tell the longer term story and put moves like today and days like today in a proper context. Great take there, as always, by Pete Carmasino of Chaikin Analytics. We got to wrap the show, folks, and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. You know, when we're talking about the move in the markets today, I would have to go back to some of the charts that we've been sharing recently. When you look at something like the QQQ, I think it was all about this channel, right? This pattern of lower highs and lower lows. We bounced off of this potential support level down here around 340, 345. We've now rotated higher. Getting out of that channel was important. Days like today just are continuing the trend that I think started toward the end of October. Now that we've broken higher, the high from July is now in play. And so again, this is a different look to the chart of the S&P 500 in some ways, just because we're now already to the July 2023 high. For the QQQ, it's right around 390, 385. We break above that, 400. You're going to the high from the end of 2021, which is not too far. That's 15 points away from current levels. Does the NASDAQ 100 make a new high before the end of the year? A day like today makes me think that is certainly a very real possibility to be thinking through. Chart number 2, Bitcoin. Cryptocurrencies have been on a really impressive run here. You had this move higher on Bitcoin in October, a couple of big up days, and just continuing to go higher. The momentum now rotating lower today, and really over the last couple days, you've had a bit of a lightening up on this trend, and now we're pulling back. This gets us out of that overbought region. I would argue still the long-term trend is just fine. I haven't seen enough to question that, because we're still making a pattern of higher highs and higher lows. But what you want to do is look back to the left on previous times when we've had these sort of pullbacks out of the overbought region. Think about what sort of short-term downside objectives would still continue that trend of higher highs and higher lows, but maybe give a more actionable pullback and a short-term rotation back to continue that uptrend. Chart number 3, Adobe Systems. You know, when I think about the market as a whole, you know, strong first half of the year, sort of weakness in the third quarter, now strength once again in the fourth quarter. Adobe is a really interesting chart because it's really been going higher through the course of 2023. Sort of started off a little bit rough, kind of a choppy sideways pattern there in the first half of the year, but then really broke out there in May. You can see the relative strength has been consistently positive as we've kept making higher highs. Now the lows have been relatively stable around 500, 510. Resistance was stable around 570. That now has broken. This is a basing pattern, I would argue, that is now resolved to the upside. That suggests much further upside in a leading name like Adobe. What's great about a chart like this, the breakout level around 570 now becomes potential support. So if you do get a pullback, think about bumping your stops up, thinking about what technical levels can help you identify some short-term support in the event of a pullback. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Pete Carmasino of Chaikin Analytics, sharing some insights from Florida. Don't forget to like this video and subscribe to our channel while you're here. We would very much appreciate it. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.